Hi everyone, welcome to week 6 of MBA 583, Strategic Planning and Implementation. This week we're going to talk about the 3 activities that comprise strategy evaluation, discuss the nature and role of contingency planning, identify and discuss 3 21st century challenges in strategic management, and explain why good ethics are good business in strategic management. So let's get started. Strategy evaluation includes 3 basic activities. We first want to examine the underlying basis of a firm's strategy. So what are we really trying to achieve? We want to compare the expected results with the actual results, and then take corrective action to ensure the performance conforms to plans. So you can think of that as a nice little flow chart. We set the standard, we evaluate the results, we compare. Did we meet the goal? Did we meet the standard? Are we above or are we below? And then take corrective action to make sure that we get to where we need to be. So when we think of the strategy evaluation criteria, we're thinking about consonance, consistency, advantage, and feasibility. So those are the 4 things that we want to look at. Okay. So today we find that strategy evaluation can be a little more difficult than it was previously. The environment that we're all working in is a lot more complex than we've ever seen it. Everything is moving so fast that we're having difficulty predicting the future with any kind of accuracy. There's so many variables that we have to look at, from technology to social changes to environment to even just the stock market isn't predictable anymore. We also are finding that our plans can be obsolete in a short period of time. If you're an IT company, things are changing weekly, monthly, daily for you all. And then we also find that there's an increase in the number of domestic and world events that are affecting organizations. Due to technology and being able to see in an instant what's going on around the world, we're finding that that's impacting our businesses as well. And the time that we have to plan is decreasing as well. So we have to look at that. So when we think about evaluating strategies, we really should look at initiating managerial questioning of expectations and assumptions. If a plan is handed to us, we really should be working in an environment where we can decide if this is really a good plan. We really should be reviewing our objectives and our values on a regular basis. And we should really stimulate creativity in generating new alternatives. So we want to think about how do we go about coming up with new ideas? Do we get new people at the table to help with ideas? Do we have consultants? How do we go about doing this so that we can stay competitive and meet our goals and strategies? We also want to look at evaluating strategies on a continuous rather than a periodic basis. So as I said previously, we want to look at evaluating those strategies daily. So where Starbucks thought that they could have a Starbucks evenings where they would sell craft beer and wine, they had to look at that on a daily, weekly basis instead of just let's do this for a year. After a year, our brand could be impacted. We could lose a lot of money. There's a lot of big things that could happen. So if you look at Table 9-2 in your textbook, it's a strategy evaluation assessment matrix. And this really helps a lot with kind of letting us know when we need to take corrective action and when we don't. So if you take an example, if we have major changes have occurred within the firm's internal strategic position? No. Have major changes occurred in the firm's external? No. Have the firm progressed satisfactorily towards objectives? No. Then of course we need to take corrective action. Okay. On the bottom, if you skip down to the last one, under the first column, have major changes occurred in the firm's internal strategic position? No. Things are the same. Have major changes occurred in the firm's external strategic position? No, we're the same. But have we progressed towards our goals? Yes. So then we can continue to stay the course. Figure 9-2 also does it in a graphic format, so that's maybe easier for some of you to look at kind of how we evaluate graphically versus in the table. So when we're thinking about evaluating, we need to ask some key questions. We need to ask, how good is the firm's balance of investments between high risk and low risk projects? Do we have some things that are tried and true that are going to continue to bring in cash, continue to gain market share, and others that are a little bit of a risk because we don't want to put everything at risk in our organization, but we have to take some risk in order to come out on top with our competitors. We also want to look at how good is the firm's balance of investments between long-term and short-term projects, so that we have cash coming in now and then cash for the long term. And then we want to look at how good is the firm's balance of investments between slow-growing markets and fast-growing markets. So you can see how all of these really position us to have cash in the short term, cash in the long term, looking at developing long-term projects versus short-term projects. And when it comes to taking corrective actions, we really want to look at, number one, the structure. We talked about that last week. How do we make sure that the structure of the organization is supportive of us reaching our goals? Do we need to be flatter? Do we need more managers? Do we need less managers? We need to look at the people that we have internally. Do we need to replace some of the key individuals? Are they not taking us where we need to go? Do we need to divest a division? Do we need to get rid of something that's kind of holding us back or causing a lag in results? Do we need to revisit our mission and vision and change some things? Are our objectives and strategies really where we need to be? Maybe we need to look at it in a different respect or get an outsider to give us their opinion. Maybe our policies are holding us back. We should look at those. Do people need to be incentivized differently? And do we need to raise capital? Or do salespeople need to be terminated? Do we need to allocate our resources differently? And is there something that we could outsource so that we can really focus on what we're doing, why we're in business? Now, once we do our plans and we evaluate, we also want to come up with contingency plans. So those are, what is our plan B? What is our alternate plans that can be put into effect when some things don't go as expected? So if a major competitor withdraws from particular markets, as our scanning the environment indicated, what actions should our firm take? So we want to already have that thought through so that when it happens, we can move quickly. We don't want to have to wait till we see something happening and then figure out what we're doing, because we'll be too late. We want to consider, if demand for our new product exceeds plans, how are we going to meet the higher demand? If there's a disaster that happens, a hurricane, a snowstorm, an earthquake, what are we going to do, right? And then when we look more deeply at effective contingency planning, what we're doing is identifying both the good and bad events that could jeopardize strategies. We're determining when the good and bad events are likely to occur. And then we also want to look at and decide the expected positives and negatives of each event. We can develop contingency plans for the key events, and we can rank them as well and know what's the likelihood of something happening and then what's the impact. Okay. If we think about 21st century challenges in strategic management, what we're finding today is that deciding whether the process should be more an art or a science. Some leaders are going more with the strategy of numbers and analysis, and others are going more with a gut instinct. We need to decide whether strategies should be visible or hidden from our stakeholders. Is it something we hold close to us, or do we put it out there? And then we have to decide whether the process should be more top-down or bottom-up. Nordstrom's is a company that looks at things from the bottom up. They feel that their customer service associates are on the front line with their customers, and they're the ones that need to make the big decisions. The CEO is the furthest removed, and so he keeps them on a course, but he really relies on the CSAs to really make those decisions. And then within all this environment, we need to consider business ethics. So what are those principles of conduct within our organization that guide the decision-making and behavior? A lot of times when we find organizations that are not being ethical, we see that they're making quick decisions, they're not considering the best long-term decision, they're more focused on the short term. Within business ethics today, we're finding a requirement for social responsibility. So we want to see our organizations that are giving back to society, that they're doing good for the organizations, and doing those types of things. We also want to see sustainability, the extent that an organization's operations and actions are really protecting, mending, and preserving rather than harming the natural environment. So a company like Patagonia will regularly say, don't buy this jacket. They don't want you to buy a jacket just to buy a jacket, because for every jacket you buy, they have to harvest more cotton, there's more dyes going in the environment. So if the zipper on your jacket breaks, they'd rather you send it back to them, let them fix it, and give you back your jacket. So those are the types of things we're looking for in our companies. And so when you look at a company, the company you're working for, a company that you want to spend your money on, what we're looking for is for them to be trustworthy, to be open-minded, to honor their commitments and obligations. We don't want them to misrepresent, exaggerate, or mislead. We want them to be a visible, responsible community citizen. We want to utilize the accounting practice to eliminate questionable activities, and kind of that golden rule, do unto others as you would have them do unto you. So all of this leads to us creating an ethics culture. So ethics training programs should include messages from the CEO, the president, the chairman of the board, really emphasizing ethical business practices, and the development and discussion of codes of ethics and procedures for discussing and reporting unethical behavior. All of these things are what we're looking for in an ethics culture in our organizations. Well, thanks for a great week 6. On to week 7.